Hello, everybody. Welcome to the third quarter market and economic update. I'm Greg Sweeney. We're going to talk about a number of items today, a couple of them in the news on a regular basis, actually. So let's jump right into it. The first item I have on the list today is U.S. debt levels. So these are the overall debt levels of the United States. And of course, every year we run a deficit. It adds to the overall debt. And as we sit today, debt is at about $36 trillion. GDP, which is a common way to measure our ratio of debt, is debt to GDP, stands at about $30 trillion. So our debt to GDP is about 120%. We've come a long way in the last 20 years. If you look at the beginning of the chart, at the time, our debt was about 60% of GDP. In the wake of the great financial crisis, there was some stimulus packages put together. At that point in time, debt drifted up to about equal to GDP, stayed there for about 10 years until the pandemic started. Then we had some economic expansionary policies again on a fiscal basis that pushed our debt all the way up to about 120% of debt to GDP. How much debt is too much debt? I'm really not sure the answer to that question. I don't know how much debt is too much debt. There are a couple of countries that have more debt than us. I will say this, though, is that our debt to GDP, standing at about 120%, is in the top 5 of developed countries around the world. So not a good place to be recognized, at least when it comes to annual debts and deficits. Next topic on the list today is the Federal Reserve. A lot of pressure coming from the current administration to reduce the Fed funds rate. Federal Reserve, who has two goals, maximize employment and to minimize inflation or to retain stable prices, is the way it's actually stated, is telling us that, hey, the economy's doing okay. If we lower interest rates, it has more inflationary stimulus potential than it does to help out the job market any further with a 4.2% unemployment rate, which is where we are today. So the Fed says, hey, the Fed funds rate is about appropriate. The current administration is saying, look, Fed funds needs to go lower to be more of a what we call neutral environment. And on the screen in front of you is a chart of Fed funds. Like I said, big debate on, should there be no cuts or one cut or two cut? A lot of energy goes into trying to figure that answer out. In 40 years of doing this business, what I've learned is the 2-year Treasury does a real good job of estimating where the Federal Reserve will eventually end up. Now, this is a little bit of what we call a blunt instrument. It's telling me in the next 2 years, the Fed funds rate is going to be somewhere around 4%. At least that's what this is saying at this point in time. We've had movement in the market since I did this slide, indicating it maybe it would be around 3.75% instead. But long story short, as you can see that the 2-year Treasury leads the Fed funds rate in terms of its overall direction. Whether there's going to be one cut, at the next meeting or not, we just passed the July meeting, no cuts there. Markets turned its attention to the September meeting. The Fed takes August off. Not saying there can't be an inter-meeting cut. They can do that. They don't need to wait until the next meeting to make a move. But the point being is, if we don't need to know specifically the date of the Fed cut, and most long-term investors don't need to know specifically the day of the cut, what the 2-year Treasury is telling us is Fed funds is probably going to be somewhere around 3.75% and 4% sometime in the next 2 years, with maybe at least one or potentially two of those happening later on this year. A lot of discussion also at the same time about how lowering Fed funds rates is going to reduce our mortgage rates. That part of the conversation I can give you a little bit more information about. And Fed funds are determined by the Federal Reserve. Long-term interest rates are determined by the market. They can and have many times in the past moved in different directions. Why does that happen? It depends upon how the market feels about the economy when the Fed cuts rates. If the Federal Reserve cuts rates and the market feels that will stimulate inflation further, long-term rates will actually go up, not down. On the other hand, if the market determines the Federal Reserve is cutting interest rates because the economy is slowing down, there's a good chance that long-term interest rates are going down. Why are long-term interest rates important? Those are what dictate where you and I borrow money to buy our houses, for example. And so what I've done is taken the previous chart, which showed how consistent Fed funds and the 2-year Treasury are in terms of their historical correlation, and compared the 2-year Treasury, which is the indicator of the Fed funds, against the 10-year Treasury. And you can see on this graph, there is nowhere near the amount of correlation or likeness of those two lines like there was on the 2-year Treasury versus the Fed funds. So what I'm saying is there is no direct correlation between what the Fed fund does with its interest rates and what long-term mortgage rates or interest rates may or may not do. Speaking of mortgage rates, here we have a quick snapshot of the mortgage rates in relation to the 10-year Treasury. You can see the current mortgage rates are about 250 basis points or 2.5% above the underlying 10-year Treasury rate. That's a little wider than where it has been historically. If you look back in the early 2000s, they were only about 125, 150 basis points, or 1.25 or to 1.5%. There's some friction in the market, most notably what we call volatility, that investors look to get paid for when markets move around a lot like they are this year, and that accounts for some of that difference. And then the market has a certain amount of, or some certain participants that are missing from the overall mortgage purchase side of things, and we're seeing that in the additional wider spreads right now. Inflation. Again, one of the mandates of the Federal Reserve is to moderate price increases. The Federal Reserve has come out and said to us, hey, you know, about 2% is our target inflationary environment. It's not so high that prices rise too fast, but it's not so low that we can't expand monetary policy and profit margins and things like that. And if you look at the graph that I have in front of you, you can kind of visualize where 2% is on that graph. I went back and drew a line across the long-term average. The long-term average is actually closer to 3%, about 2.75%. Current inflationary environments are showing at about 2.7%. The question I have is a 2% inflationary environment really sustainable in this market environment? Of course, if we looked at the last 10 years or so, we had a very low inflationary environment. We had a very low interest rate environment. There's a lot of folks out there that are trying to, are waiting, if you will, for interest rates to go back down. I'm not sure we're ever going to see that. The real anomaly that we had was the zero or close to zero interest rate environment in the wake of the great financial crisis that lasted 12 years or so until about 2022, 23. That was what was unusual. The thing is, there's a lot of people who came into the market, came into the home buying portion of their lives, and think 3% mortgage rates are normal. They're really not. We can go back for a long, long time and find that 3% is really quite an anomaly. So it was the last 10 to 12 years, well, I guess as we sit here now, 15 years, that was the anomaly, not the 7% or so interest rate environment that we're seeing today. So back to the inflationary environment, we're probably looking at an inflationary environment that's probably not going to be 2%, which is the Fed's goal, but probably more in that 2.5 to 3.5, maybe a tighter range of 2.75 to 3.25 inflationary environment. And I don't know that there's a lot of propensity to move outside of that range. A lot of discussion earlier, I guess about 4 months ago now, at the beginning of April, what tariffs are going to do to inflation, and if tariff rates go up, the consumer prices are going to go up. So far, that hasn't been the case. I'm not saying it won't be the case, but so far, it's not the case. And the reason for that is there's a lot of places where costs are occurred in the whole manufacturing process, from raw materials to producer to transportation to retailer, wholesaler. I missed in that process, consumers, right? There's a value add along the way. And it's hard to tell when we start talking about inflation where those price increases are going to occur. To give you an example of what I mean by that, imagine a balloon that's full of air and you're holding it in your hand. You can push on the elastic and you know that the air where your finger is went in has been displaced somewhere. It's just hard to figure out in that balloon where it was displaced, right? Same thing's kind of happening with inflation right now. And the tariffs might be putting a little bit of upward pressure on inflation. It's hard to identify where that's occurring and where and who's covering the cost of those tariffs. Safe to say, though, tariffs are higher than they had been in the past. I'm going to give you another description of tariffs that you're really not hearing on the news every day. So tariffs are a fee that's being placed on goods that are outside the United States coming inside the United States. Now, the calculation for GDP, gross domestic product, isn't particularly difficult. It's consumption by the consumers, which is you and me. It's government spending. It is business spending or business investment, to be more specific. This isn't investing in stocks and bonds. This is property, plant, equipment, and things like that that businesses do. And the fourth portion of the formula is exports minus imports. And to the extent that we import more than we export, it is a deduct from GDP. Okay, so tariffs are aiming to reduce that deduct, hopefully eliminate that deduct. And also tariffs are looking to correct a sustained trade deficit, which we're seeing on the page in front of you right now. Our trade deficit, which means goods that we are importing from our foreign trading partners, at one point was up to about $140 billion a month. This is a monthly graph. Currently, our latest number is a $71 billion deficit. Now, the idea of a trade deficit is you might run a trade deficit for a month or two, and then we want to turn around and we have a trade surplus. And so the long-term line should be somewhere around zero. Okay. And I know there's been a lot of discussion about how if we increase tariffs, the price of goods are going to go up. But the reality of it is what we want to also make happen is we want this trade deficit to erase itself. So on an ongoing basis, we are closer to a zero trade balance. So not a trade deficit, not a trade surplus, but somewhere close to zero. The problem with the sustained trade deficit that we see right here is that eventually we give away our economy and we give away our jobs and we give away our industry, right? Because to pay for the goods that we import, we have to hand our foreign trading partners $140 billion a month, $71 billion a month, going all the way back to early 92, $10 billion a month. Eventually, we give them everything and they turn around and they invest those dollars back in the United States and they own our farmland, they own our industries, they own our stocks, they own our bonds. So a sustained trade deficit is not a good situation to be in either. And the other thing that these tariffs address are this sustained trade deficit, in addition to providing more income into the Treasury for the United States. So market summary, how does all this translate to you and me as an investor? First off, interest rates, right? If long-term interest rates go down, as we invest new money, we don't capture as much incremental income as we would have if interest rates stayed higher. On the other hand, lower interest rates make investments in other industries, businesses, farmland, whatever business we're all involved in, less expensive, which means we don't need as much of an incremental profit margin to be able to offset the interest rates on those loans. As the interest rates go up, right, what that suggests is we either have an inflationary and increasing underlying inflationary environment, or some sort of mismanagement, or more bonds than investors are willing to buy, which we call supply and demand imbalance. And at the same time, when interest rates go up, if we're an existing bondholder, the market value of our bonds goes down. I know that's kind of counterintuitive, but as interest rates go up, existing money, the value of existing money in bonds goes down. Stock market, to the extent that interest rates are higher, they continue to compete with the stock market. At some point, interest rates on bonds get high enough, whereas investors were willing to settle for the assured income that comes from interest on bonds versus the uncertain return that comes from stocks, which is mostly market value, changes in market value, either up or down. If interest rates become high enough to entice investors to put money in bonds, U.S. Treasuries, for example, there's a downward pressure on the stock market because money leaves the stock market, goes into the bond market. Economically speaking, the Federal Reserve, again, going back to what I mentioned earlier, their goal is to moderate price increases, in other words, low inflation, not zero or negative, but low inflation. At the same time, maximize employment, so the consumer, which is about 2/3 of GDP, has money to continue to participate in the economy. Consumers, I probably have a little bit different perspective of the consumer than we're seeing on the news. We get a lot of news data that says the consumer is in a good spot. I would say, and I've been saying this for 6 months now, the consumer is a little bit more marginalized, I think, than we're led to believe. Why do I say that? Is we still continue to see some upward pressure in delinquencies on credit cards, a little bit of upward pressure on delinquencies in car loans and things like that. And so I think the consumer is feeling some pressure. It's not aggressive pressure, but it's some pressure. Finally, asset allocation. So within the funds that we manage on your behalf, our equity allocation in those funds has not been changed. Our equity allocation remains the same. We are turning the dial a little bit within the allocations. What do I mean by that? Is we're taking our growth allocation within the equity market and realigning it a little bit more towards value, lower price earnings ratio, a little less volatility. So to the extent that we see those high growth names out participate, like we have in the Mag 7 over the last few years, we rode that horse, so to speak. At this point in time, we're getting a little more defensive. So we've probably rotated about 5% into value out of growth over the last 6 months or so. Represents a little more of a defensive posture, not aggressively, but a little bit more defensive posture. On the fixed income side, we have moved away from acquisition of corporate credit. Corporate credit we find very expensive. We're able to capture a lot of incremental income in the mortgage and asset-backed space. What do I mean by that? Overall coupon interest income yields are higher than they are in corporate bonds, and credit quality is better as well. So more defensive in the fixed income portfolio, higher credit quality, higher coupon cash flow, and combining to be again a little bit more defensive position on our fixed income portfolios. Again, you don't see this happening behind the scenes, but this is what's going on. So thank you for joining us on the call today. You have a wonderful remainder of your week, and we appreciate your business. Thank you very much. Bye now.